I wanted to spend a little bit of time now taking you through our history. My wife and teammates told me yesterday to cut down this bit and get to the juicy stuff. And any husband knows it's not a great idea to go up against your wife. But I think our history is important, especially given the fact that many of our mistakes we have made as investors, we've also made mistakes I think we have all made as investors. It is how we learn to be better from the history. My story starts back in 1999. The internet was just taking off, and a few mates and I thought we wanted to get involved. Due to my background in investment banking, we sort of honed in on finance and personal wealth. It also helped that as young investors we were knee-deep in IPOs. It was all the craze at that time. But getting information and access to floats was very difficult, so we thought there was no better place to start. We launched floatnews.com.au in December 1999. Float News was the first comparator website for IPOs in Australia. We had the right idea, growing to around 40,000 members within the first 3 months, even with an ugly website. There was a huge demand for direct consumer access to IPOs, and the internet was a great way to deliver this. The problem was there was loads of risk and concentrated exposure to not so good businesses. Luckily for us and our members at the time, it seemed that nearly all floats went up with the tide. Though it did not last. High tide was the dot-com boom in early March 2000, and over the next couple of years, more than $5 trillion was wiped off markets around the world. We had created a business where greed was good, and for a short time, it was rewarded. We had to go back to the drawing board. We really needed to develop a service that first and foremost helped our members find good investments, and secondly, be able to sleep at night. We needed to expand our services to provide members a wider investment choice and more balanced opportunities. So in 2002, we introduced managed funds into our comparator website and renamed it FundSmart, essentially becoming an investment supermarket providing numerous opportunities across a number of different asset classes. However, once again, the ever-present nature of investors' fear and greed would play its part, and our members were again ambulance chasing returns. They were loading up on the best performing funds, most likely at the worst time. Inadvertently, we had provided them the perfect tool to chase returns. We went through the era of tax-effective schemes such as agribusinesses, I'm sure we all remember them, capital guaranteed funds and brick funds. CDOs and hedge funds were also gaining traction. It was at this time we also realised the fees being charged by the fund managers were huge. So in 2004, we changed again. And we relaunched our website as InvestSmart. We introduced our free portfolio manager to help members see what they had and where they may be overexposed. Providing tools to our members to monitor and plan their investments we felt was critical. It was still fairly basic. Most fund managers didn't provide the asset allocation breakdown for each of their funds, but it was a start. We also introduced our trail cap program, where we started rebating trailing commissions we received from our members' managed funds. Today we have over 20,000 members nominating us as their advisor on $1.5 billion and growing. We continue to pay over $2 million back in fees to our members each year. However, we still thought we could do more. Don't get me wrong, our members were loving the service. Why wouldn't you when you get a cheque in the mail? But we needed content. We needed a voice to tell our members about their risks, benefits of other risk classes, diversification, super, tax and fees. So we joined with Fairfax in late 2007 to start getting more content into our services. Soon we had good, relevant content filtering through to InvestSmart, and everything looked as if it was going to plan. But unbeknown to us, the GFC was just around the corner and everything was about to go out the window. Investors were well overweight equities and well underweight cash and fixed interest. Many investors were hit hard. GFC again confirmed to us that our members and the general public had no idea about asset allocation and diversification. Set and forget portfolios just didn't work. We also worked out quite quickly that Fairfax had no idea in running financial services companies. Over the next few years, we treaded water and finally bought back the business inside an ASX-listed vehicle in October 2013. Things now move fast. We bought another fee rebate business in 2013 called YourShare, and now providing more rebates to more clients. We then bought Intelligent Investor in mid-2014, which provided us with quality Aussie equity research with a proven investment framework, which James Carlisle will talk about soon. We now have 10 amazing equity analysts in this business with a formidable track record. And earlier this year, we bought Eureka Report for that much-needed broader wealth commentary on issues such as asset allocation, diversification, super and tax, what we really wanted from Fairfax but sorely never received. As investors and as a business, we have evolved with more than our fair share of bumps along the way. And I think, though I'm a little bit biased, we have built one of the best retail platforms in Australia for Australian investors in the country, with our members now getting 3 amazing services in one place, including InvestSmart's free portfolio services, Intelligent Investors Equity Research, Eureka Report's broad wealth commentary. And that's our history. Hopefully it didn't take too long. But here we are today, and as investors, we all want to know what to do next. Mitch will talk about human nature making us bad investors in a little while, but let's just say that fear and greed will always be present in our marketplace. Fear and greed will create noise, both short-term and long-term, and not having an investment framework to filter this noise will be the greatest risk to your long-term returns. Obviously, the US elections is a recent example of short-term noise, with markets seesawing on each US poll over the last few weeks, to markets taking a dive yesterday on a Trump victory to only bounce back overnight. But this is short-term noise, and in a year or so, if not months, it'll be more or less forgotten. Markets and stocks will adjust, there will be winners and losers, and we'll move on. The bigger noise in markets today that's persisted for years and maybe years to come have been low cash rates, forcing us all into riskier assets on the hunt for yield. Looking at our own portfolio, our own members' portfolios on a whole, we can see that many of our members are becoming less diversified for this elusive yield. Rebalancing portfolios are becoming a necessity. We're using our voice at Eureka and Intelligent Investor in many ways, trying to encourage our members to take a closer look at their portfolios. The next few slides, I want to take you through some specific examples of how this hunt for yield is affecting markets at a stock level. I've chosen just a few stocks, but there are plenty of examples such as the banks, Telstra and A-REITs. Hopefully most of you have followed our rantings over the last few years and were able to avoid these yield traps. This is Cochlear versus the inverse of 10-year bond yields. Basically, as cash rates have gone down, Cochlear share price has gone up. The correlation is obvious. Transurban is a similar story. And it's not just Australian stocks. The same experience is playing out across the world, with Johnson & Johnson in the US as another example. And it's not just individual stocks. We believe the hunt for yield is affecting equity markets in general, with the wider Aussie market's average PE ratio now 20% above its 10-year average. That hunt for yield means many of us are holding more equities than cash and fixed interest, and this is flowing through to valuations. We're not saying the Australian market is going to crash. We don't know. What we do know is that by strategically allocating your portfolio between different asset classes and within those asset classes, you can better manage the risk of any eventuality. It's about finding the right mix of assets for your investment goals and risk appetite. If you go to bed every night worrying about your portfolios, it's probably a good sign that you don't have the right mix. And similarly with the US market, at this time, we believe US equities are also a little overcooked, with PE ratios currently 25% above the 10-year average. Again, we're not saying they're going to crash. We're just saying there are some warning signs emerging. And right now, we find better value elsewhere, such as Europe and emerging markets. so we change our asset mix internally accordingly. We still hold US equities, but just not as much as many other fund managers. Again, it's about finding that right balance. So as I've been saying, diversification, we believe, is the key to building better portfolios. And even though there was plenty of research and maths to back up our claim, here is a table that visually shows that each year different asset classes behave differently. It looks quite complicated. But each line shows in green or red which asset classes within that year went up and down. Having exposure to them all will iron out volatility and should improve your returns. Performance will be further improved by being somewhat tactical in the asset classes you choose to go overweight and underweight at any time. So this all sounds relatively easy, and many of you probably already know this. So why don't we do it? That's easy. It's very hard to know what mix of asset classes you're invested in at any given time. Many of us hold assets across different platforms, different fund managers, and different types of securities that can get confusing. For example, there are many securities on the ASX that look like Australian equities but act more like property, international, or fixed interest. This is why over the last year or so we have supercharged our free portfolio manager to provide our members this information on a timely basis. Our portfolio manager now looks under the hood of tens of thousands of securities, including managed funds and shares, to work out exactly what your overall asset allocation is. We then compare your asset allocation against our own internal asset allocation for your given risk appetite, to provide you a health check to show you where we think you may be overweight or underweight a given asset class. And this changes continuously as prices move up and down. We have 20-minute delay prices on our shares and daily prices for our managed funds. And will change even more dramatically if you change your risk appetite as your investment needs change. Constantly monitoring your portfolio and rebalancing where necessary is key. We developed the health check to hide the complexity of this table. They moved on too quick. And simply give you a number that moves around and keeps you aware of when you should take a closer look at your portfolio. This is my portfolio, and I'm currently 94% diversified. 100% is perfectly correlated. It's probably hard to see, but not so hard here. I'm still a little overweight Aussie equities, about 4%, and a little underweight international. But for my investment needs, I'm happy with my investment mix against my investment time horizon of 7 to 10 years or a growth profile. I don't need to be exactly 100%, just close enough to be comfortable with my risks. The important thing is to understand if I did nothing to my portfolio over the next few years, it would get out of sync with my risk appetite and my health score, the 94%, would deteriorate. And InvestSmart would be sending me emails every Friday alerting me to the fact. This rebalancing problem is at the heart of why set and forget does not work. To give you an example, I have used the InvestSmart Portfolio Manager again and the health check to imitate a typical balanced portfolio in 2001, and John mentioned this in his opening address. My health check here shows that I'm pretty good, 98%, close enough, I'm happy with my risk. But if I did nothing over the next 6 years, remember this is in 2001, if I did nothing over the next 6 years while equity markets rampaged ahead, my health check would have deteriorated, leaving me a mix of assets that were no longer in line with my risk appetite. By 2007, my health score would have deteriorated to 73%, leaving me with more than 70% of my portfolio in equities and looking more like a growth or a high growth portfolio. By not rebalancing once between 2001 and 2007, I would have lost 50% of my value of my portfolio following the GFC. Now, don't get me wrong, even if I had rebalanced, I still would have lost money, but it would have been closer to 30%. And you may be thinking that's fine because if I just stayed where I was, the markets rebounded in 2009 and I would have done okay. But here's the trick. If you were continually rebalancing over this time, you would have been tipping out of equities and into cash and fixed interest around 2007, maybe even earlier. And then in 2008, maybe 2009, because equities had dropped so much, you would have been tipping back into equities and out of cash and fixed interest. what you've effectively been doing is you're ironing out the volatility of the markets. But not only that, you would have lost less money on the way down to have more money to invest on the way back up again. Overall, rebalancing during this period of time would have given you a better outcome. And we tend to preach about this stuff a lot, obviously, but that's because it's important. We fundamentally think investors need a plan. They need a framework to filter market noise, and they need to diversify across many asset classes. The more asset classes in your portfolio, the more levers you have to pull in order to ride out volatility and move from A to B to achieve your long-term returns. But no matter how many times we urge our members to diversify their portfolios, we still have many members who don't. To highlight this problem, I want to take you through some stats of our own members' portfolios. We've collated these as a whole, so there's no individual portfolios. We have over 48,000 members using our free portfolio services, managing over 75,000 portfolios. We continually look at these portfolios as a whole against our own internal diversified investment portfolios, conservative, balanced growth and high growth. This is a pie chart of, on the left-hand side is our whole of our member conservative portfolios. There's about 6,000 of these members using this service. And on the right-hand side is what we believe they should be invested in. And as you can see, they're nowhere near aligned. Our conservative members have nearly 80% of their assets in equities and property, where we believe they should be the other way around, with 80% in fixed interest or cash. If the interest rate cycle changes, and at some stage it will, these asset classes are probably the most likely to cause major capital losses. And this is our balanced portfolio. We have about 9,000 of these members. And again, you can see that they're completely overweight in Aussie equities and property compared to what we believe the ideal should be. And our growth and high growth members, over 25,000 members collectively, are similar weightings to conservative and balanced. They've got a little bit riskier in international equities and property. But here, their actual health scores have improved because we expect them to be in higher growth equities and property. So their health scores have improved, but they're still not diversified as much as we would like them to be. Interesting, but not surprisingly, our high growth clients remain predominantly in property. Nearly 50% of all of their assets are in property. And even though this group holds more international equities than any of our other members, they are still massively underweight. So here they own about 6%. In the previous slides, it was 3 to 4 to 5%, and now it's about 6%. A big part of our business continues to be education. In closing, as you can see, education is a big part of our business. We now have over 700,000 members using various parts of our services, and we understand that each of you are different, have different goals and different risk appetites. A set and forget portfolio is no longer acceptable. It is the biggest risk to your long-term returns. I would encourage you, in fact, I would implore you to use our free portfolio services or something similar. Take a health check, see where your risk lies, make sure your asset mix is in line with your risk appetite. Thank you, I appreciate your time, and hopefully today's presentation has helped you to build a better portfolio in the future.